So the authors in this paper, want to understand the momentum of various styles. So if you would go back into the research of, say, for instance, the size factor or the value factor, you would see that it works well in some time periods and works poorly in other time periods. And so the authors here are thinking that maybe there's some momentum within those styles. And most of our research that we summarize in these videos is related to price momentum, and that's the momentum of different stocks and their prices. And but in this paper, it's interesting to see, well, is there actually momentum in different styles? So the way the authors did this is they split the FTSE 350 into style boxes that you would see that momentum, or that Morningstar, I believe, has trademarked. But so they would split into three groups of size. So you would have large cap, mid cap, and small cap stocks, and then also three different groups of value versus growth. So you'd have value, blend, and growth, and they basically formed 9 portfolios through the intersection of those two factors. So 3 times 3 is 9 portfolios. And then, as you've seen in some of our other videos, you would see that they've got a 3-month, 6-month, 9-month, and 12-month formation period. So which of those 9 style portfolios would had the highest return over the past 3, 6, 9, 12 months? And then they hold, well, they would also see which one had the worst return over this formation period, and they would form a zero cost portfolio. So they would go long one of them and go short one of them, so buy and sell, over the next holding period, which would be 3, 6, 9, or 12 months. And so they would see, well, what's the difference between the long portfolio and the short portfolio? And so that in that way they would see if there's momentum within styles. And obviously what they found was that in most cases they would be going long the small cap portfolio and short the large cap portfolio, because, as has been found in prior studies, small cap stocks tend to outperform large cap stocks. But they didn't find there to be any particular momentum within value or growth companies. But anyway, whenever they formed these portfolios, they made this chart of statistics. And what we see, what's most important, first of all, is the T statistic of these returns. So if we have 1 asterisk, we have significance at the 10% level. Or if we have 2, we have a significance at 5% level. And there's only 2 cases where there is significance. And that's when we form the portfolio, depending on the past 3-month returns, and held it for 3 months, or the 6 and 9-month holding period. So there tends to be some style momentum in these formation and holding periods, but the rest of the formation and holding periods we can't really rely on as not being zero difference between the past winner and the past loser style. And so then, as a comparison, the authors looked at true price momentum, which is what they call regular momentum strategies. So looking at the past price, the stocks with the highest decile of returns in the past over 3, 6, 9, or 12 months, and shorting the ones with the lowest past returns over the lowest decile over 3, 6, 9, or 12 months. And then they held those zero cost portfolios over the next 3, 6, 9, or 12 months. And we can see here that there were a couple of levels of significant, or where the buy minus sell, the zero cost portfolio, was statistically significant, and that's in the 3 or 6 month formation period and the 9-month holding period. And we see that these returns are significantly more than the style momentum returns, which were a bit less. And so we might conclude that regular momentum strategies do better than momentum of actual styles.